Hi, I'm Covenant, popularly known as Covenant CTFX or CTFX. I traded patterns for years, but deep down I longed to understand how the market really moves. Well, I found it. I found it in a house. In the few minutes of this video, I'm going to be showing you the foundation of how the market really moves, end risk open range concept. So HORC stands for end risk open range concept. Andre is the author of the concept, but you see these three here? These are the engine. That's the engine of the concept. This is actually what we trade. The open range concept. That is what we trade. So what is open range? What does open range mean? Listen. The market moves in zeros and ones. You may not know yet, but your current knowledge even testifies to this. You know why? Because currently you even know at least that there can only be two participants in the market, either buyers or sellers. Well, that in short tells you that mathematics and physics are like the foundation of the algorithm that moves this market. And I will show you how this is true. So in HORC, this is what we believe. We believe, the open range moves the market, the way the market opens. So what is open range, first of all, before we go into all that? Open range states that how the market opens in a session, day, week, month, or year determines the dominating participant, either buyers, which are represented with 1 in algorithmic term, or sellers, which are represented with 0, for that specific period of time until either the participant completes its 3 cycles and flips or the period ends. This is very straightforward. You just need to sit down to understand it, but I'll even take it further. So when I say that we view the market from the lens of the algorithm, from the lens of mathematics, physics, it's not like we are solving mathematics or physics whenever I want to trade. No, it's just, I just want to bring you into the foundational knowledge of it. It's not like we draw some of these things or we state some of these things whenever I want to trade. No. But yeah, this is the first thing I'm going to be showing us. This here is very important. This is basically how the market moves. You notice that the first thing you notice here is these waves. It's like waves you get. This is exactly how the market moves. That's why when we go to the higher time frame of market, you see that the market moves in waves. The market doesn't move like a bullet. It doesn't move in straight lines. It moves like these waves. Do you get? So basically, we believe in HORC. What HORC believes is that since we understand that the market moves like that, then you remember this thing that you learned in physics about wavelengths? Yeah. This is lambda. That's the symbol for wavelength. So it's basically the distance between here and here in a wave diagram. Do you get? So that's a cycle completed. Do you get? That's a cycle completed. That I'm bringing you to the understanding of like how the market moves. So basically, let's take this as the open, this line here, let's take it as the 0000 for a day now. Yeah. So the way the market opens, in this case now the market went up first, taking out, let's assume that it took out the high of the previous candle, of the last candle that was found in the previous day. Do you understand? That's D, because we are talking about daily here. So D plus, or you can represent it with DP, anyone you want. You get, which means that's bias. This is 1. Do you get? In algorithmic term, this bias, that means bias started the movement. This is basically where our open range concept originates from. It originates from the way this candle opened today, or the way it opens the session, or the way it opens a week or a month or a year. Do you get? So this year is basically talking about buyers opening this particular day on this diagram now. So buyers have 3 cycles to make. By the way, 3 is the most powerful number when it comes to trading, and even in real life 3 is the most powerful number. You need to go and think about that. Yeah, so by the way, these buyers have 3 cycles to make. Many things in trading is three, the power of 3. Just think about anything in trading, you see that it's talking about three. So that tells you 3 is very powerful whenever you want to integrate mathematics into trading or anything. So, but these buyers have 3 cycles to make. This is the first cycle, this move here. Then this move here will be the second cycle. Then this is the third cycle. What is that telling us? That tells us that when this 3 cycle is completed and the market comes down like this, to take out this low again, because at each of this cycle, this side must have been taken by this particular area. So that's buyers. Then if they come and take this low again, this low is a flip point. You can see I put flip point there. So that's where the participants, the dominating participant of the market, switch to sellers. Are you with me? The same with this case. In this case now, sellers started the cycle. This is the first cycle of sellers. That's 1. This is the second cycle. That's 2. This is the third cycle. That's 3. Do you get? So before that's even if they flip. It's not every time that they flip, but if they flip. So that's basically how we know the participant at every point in the market. This from here, in fact, is already telling us something. One of the first things already telling us is, showing us some of the myths that we've had in trading for so long, especially with even SMC and a number of strategy. I'm not saying they don't work, but at the same time, there are just some things that you just need to think deeper in them. You just take it as they told you. Even what I'm telling you right now. Basically, they've always told us that buyers at every highs and at every lows, we have sellers. At every lows, we have sellers. Do you get? That's not true. That's actually not true. HRC brings us into the understanding, because if you check what I just showed you here, it's telling you what this thing is showing you here is that at highs there can be buyers, and at lows also there can also be buyers. Not necessarily sellers, because T plus buyers here, buyers open this day. Buyers have 3 cycles to make. So buyers are at this high, at this low, at this high also before they flip to sellers. Sellers also can be, because they have 3 cycles to make. They have, if you extend this thing, this will be their first cycle. This will be their second cycle. So you can see sellers can be at lows and also at highs. Do you understand? That's very interesting. That's a very, very interesting thing to first find out. That's the first thing that HRC demystifies. And also another thing that that it debunks is that where liquidities are, they used to say buy side liquidity at highs, sell side liquidity at lows. When you take this a little bit further into liquidity, you start to realize that sell side liquidity can be at highs. I'm telling you, it's not even about sell side or buy side liquidity for HRC though. It's about the volume open range, that is the volume of the open range of the liquidity that are there. Liquidity is liquidity. Just in HRC is just true liquidity. True liquidity means we are not guessing whether liquidity has highs or equal highs, those are patterns, or sharp lows. It's true in many cases, but at the same time, there will be some sharp lows that price will not take, because that's not the true liquidity in price. You see it in some cases in price action. Do you understand? So what's that telling us? That tells us that there has to be a way to know where the true liquidity is, and that's what, if you take these things, signals, because what I just did here was marking signals. This D plus was marking signals. Do you understand? If you take signals a little bit further, I will show you how you can get that in a minute. You will be able to know where the true liquidities are in the market. And these true liquidities, they are not, you know, sometimes they can be anywhere, but you know exactly where they are. Very powerful concept. Very powerful concept. But with HRC, it's about the volume of the true liquidity, which is either daily true liquidity or monthly true liquidity or sessional true liquidity. Do you get? So that's very powerful. That's a very powerful thing to know. So let's from here, let me just take it a little bit further. When you understand this already in HRC, the next thing that you need to know is how to, from here, you already even know how to mark signals if you are really paying attention. Then from here, you start to understand true liquidity. You get to understand true liquidity. What will allow you even know whether a place is true liquidity or not is exhaustion, assertion, the kind of assertion that we have there. This, let me show you that. The kind of assertion that we have there, that is, for example, if we have buyers at this low, if sellers come to take buyers on, let's say these are 2 different days, yeah, this line is 1 day, this other side is 1 day. If sellers come to take buyers, that's exhaustion assertion. That is, price is exhausting each other. Do you get? The high that connects them, the origin is a true liquidity. That's how you get to know true liquidities in price at different price points at different times in price. So it's that simple. So you get to understand exhaustion assertion, momentum assertion. Momentum assertion is just talking about break of structure. Is the one that we used to know break of structure. That is, for example, if D plus take out D plus, it's not D minus taking out D plus. So there's now exhaustion. It's just continuation. This is a true break of structure. So in HRC, we can easily know true break of structure, or when price is ready to reverse to come back to this low, or if price is just ready to come here and keep going. Do you get? It's very easy to know. So when you understand these things, you get to also understand the true zones, because in HRC we understand that when zones carry, for a layman, we understand that when zones carry true liquidity, yeah, they are not true zones. You can't rely on those zones, no matter how rich they look, no matter how beautiful they look, they are not true zones. So it's just as simple as that. So what are the things HRC help with? What are the things HRC help with? Let's take that in a minute. So the core advantages of HRC, these are the core advantages. Number one is to know the structure of the market based on participant and exhaustion assertion. Just like I've shown you, with HRC, people that, because I found out, and in fact, you might already know that the major reason why people fail technical wise, when it comes to technical analysis, is because it's majorly because people don't know how to determine the bias of the market. They don't know how to determine the direction of the market, and that's what HRC really comes to solve. It comes to solve. With HRC, we are not confused about the bias of the market, and if that is already solved, 60% of your problem, I believe, in technical analysis is already solved. Do you understand? So the second thing is it shows you where the true liquidity is. The third thing is that it shows you where the true zones are in price action. So guys, let me show you just in a bit on price action what everything I've said here will look like. Let me show you just what it will look like on price action. So when you eventually come into HRC, this is the kind of thing that it will look like. This is the kind of thing that it will look like. We mark our coordinates like this. And then from here I can see, you see where I put this line, this is a yearly true liquidity. I can see where the true liquidities are in price action, and I can see where the true zones are in price action. Very interesting way of trading and very precise. So guys, stay with me on this channel. Every week like this, I will drop a video at least that will help you understand HORC better. Till our next video, make sure you subscribe, like, and comment. See you soon.